Hello and welcome. I'm Michael Scofo, one of the partners here at Fortress Wealth Planning. Today's brief discussion focuses on insurance planning and specifically its role in the financial planning process, along with how we view insurance as fiduciaries. It's important to know, though, that no one size fits all when it comes to insurance planning. So, the types of insurance. Most commonly, there are two types of life insurance, term and permanent, and I'll break down the two. Whether the insurance is term or permanent, it is important to know, though, that the death benefit is free of income tax in either case. Term insurance provides coverage for a specific period of time, typically 10, 20, or 30 years, for example. The death benefit is paid only if the insured passes away during that specified period of time. It's generally a more affordable option because the insurance company is assuming that you'll live to life expectancy and the insurance will not pay out during that term. Typical uses are income replacement, mortgage protection, or protecting any other debt that may be in place, covering child rearing expenses in the early years while you're building your savings and investment strategy. And in business planning, is typically used for buy sell planning issues. If you are in a partnership and one of the partners passes away and you're trying to redeem their ownership, life insurance is often used, or term in this example, for that purpose. And or key person, protecting against the loss of a key individual in the business. Permanent life insurance is just like the name mentions, it's permanent. It lasts your entire lifetime and typically includes a cash value component, pays a death benefit whenever the insured dies through life expectancy, and the policy lasts through lifetime, assuming that the premiums are paid and the policy is in good standing. It tends to be more expensive due to the fact that it is underwritten for your entire lifetime and the cash accumulation component. And most common uses are leaving a legacy or wanting to leave money behind, estate planning, complexities, maybe paying estate taxes, insurance is often used, or permanent policies are often used in that instance. Cash value as an investment, which I'll talk about in a few minutes. And then in some instances, long term care coverage with policy riders. So, term insurance, what amount is adequate? The big question most people have is how much insurance should I have? This can be complicated because it depends on the insurable need. What are we sharing against? And we don't want to overinsure as it does come at an opportunity cost. However, there are some general rules of thumb for younger folks. Maybe they don't intend to start a family for a few years and only depend on each other. In that case, maybe a 10 times earnings is usually a solid way to determine adequate coverage for these folks. And it is usually inexpensive to put in place for young people. However, when life gets more complicated, more factors come into play, such as specific financial goals we're trying to protect, age, number of dependents. Are we trying to replace income? Are we trying to just cover living expenses? Specifically for term insurance, though, we are using insurance to bridge a gap during a vulnerable period of time in one's life. So, insurance as an investment, we do not view it as an investment. Our thoughts as fiduciaries on using insurance as an investment vehicle is that it is expensive, inefficient, and we don't recommend it. We believe that insurance serves a purpose, but should only be purchased for an insurable need, not as an investment. If the purpose is for an investment, there are more cost efficient and simpler options available. In our view, insurance serves three main purposes. First would be to cover a vulnerable period of time, maybe a short term need. For example, that young family that is highly dependent on one or both parents' income while they're building their savings and investment strategy. The loss of one income would be catastrophic to the family, and therefore you're trying to protect a gap in this example. To cover the repayment of debt, such as a mortgage, we need coverage for a predetermined period of time, and the need tends to decrease over time. The second is to leave a legacy behind or transfer wealth. Perhaps you want to leave something behind for heirs or charity. You'd want the coverage to last your whole life, which means it needs to be underwritten for life expectancy. And the third reason is wealth preservation or to protect a legacy. And this one is a bit more complicated because it involves estate tax laws. High net worth families subject to estate tax thresholds, whereas a couple has an estate valued over 30 million, might consider funding a whole life policy to pay the estate tax liability that is due at the second passing as a means to preserve accumulated wealth. In this case, life insurance needs to last through the entire lifetime and would be owned outside of the estate within an irrevocable life insurance trust, also known as an ILIT, so that the death benefit is not included within their taxable estate. Overall, one should buy insurance for the insurable need, coverage, for example. Most people should utilize insurance for this reason and this reason only, and separate investing away from insurance products. Annuities. They are a form of insurance that is issued by a life insurance company, and there's several different types. A deferred annuity, it accumulates value over time, whereas payouts begin at a future date. That growth over that accumulation period is tax deferred. However, it is important to note that any withdrawals from an annuity are subject to ordinary income tax, so they can be tax inefficient. In a deferred annuity, it can be annuitized or withdrawn based on policy riders if you choose not to annuitize. Fixed annuities are pretty simple and straightforward. They act more like bank CDs. Principal is protected, tend to be low risk, and the interest rate is guaranteed for a period of time. An immediate annuity is one where you make a premium payment and immediately expect an income stream in return over your lifetime, over a specific period of time if you choose, maybe even over multiple lifetimes. Think of it something like a pension where you choose a repayment or a payment option. And then lastly, you have variable annuity options, which are often mentioned as investment vehicles. We have some views on that, and we'll talk about that here in a moment. But they do offer some sub-account investment options that would be exposed to the investment markets. However, the returns do fluctuate, but the annuities provide some downside protection in many instances, but it does limit you on the upside as well. So let's talk about some pros and cons associated with annuities. Pros are that they offer a steady stream of income. There's no contribution limit. The money does grow tax deferred, although any withdrawals are at ordinary income tax rates. So again, they can be tax inefficient. There are death benefits offered within many, assuming they aren't annuitized or the amount of contributions haven't been completely withdrawn. And again, tax deferred growth. Some of the cons are inflation risk, particularly with fixed annuities. There are hidden fees and high commissions that are paid to the agents that issue these policies. Many folks we find come to us and ask us to review the annuities. Maybe they didn't quite understand exactly what they owned and are often disappointed to find out that the surrender charges associated with getting out of the annuity are can be substantial and for a lengthy period of time. So, just be cognizant of that. Again, lack of surrender and tend to be lack of control in those instances. They can be very complex instruments. So this is something where you want to go into an annuity contract eyes wide open. As an investment philosophy, our firm is not a fan of annuities. We feel as though that if you are looking to have exposure to the market, you can save significantly on fees, reduce the investment costs, and with a properly diversified portfolio, achieve the same outcome at a much lower, more client-friendly cost structure. So that brings us to the conclusion of today's discussion. If you would like to discuss any of the things that I mentioned on this short video in greater detail, there's a schedule call link that you can click and schedule a time that works for you. Thanks for being with us, and until next time, be well.